Hello, welcome to this week's podcast brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in forex, stocks and commodities in multiple destinations. I'm Michael Hewson, and joining me again is Pepperstone Senior Market Strategist Michael Brown. Good afternoon, Michael.
Well, very good afternoon to you too, mate, up in the north of Scotland. I hope you're surviving up there and didn't get battered around by that storm last week too much.
No, we arrived slightly ahead of it, so we basically made sure that we got here before the worst of it hit. So all good here. The sun's out and it's not too chilly.
Good, good, good.
Anyway, as we start Q4, we've got a story of a lot of record highs this week, not only in the FTSE 100, as well as US markets. The German DAX has joined the party. The Nikkei 225 has also surged, as has gold and silver and pretty much everything else. Well, year to date, I think silver is up 60% year to date, and it's closing on that $50 level that we last saw, I think, back in 2011 or 2012.
Yeah, well, I think we've actually taken out $50 now in literally in the last half hour before we started recording this podcast. And yeah, I think you're absolutely right. The general sort of vibe of the week just seems to be summed up by the phrase "buy everything." Now that's not investment advice before any compliance people come at me, but stocks on Wall Street have rallied, stocks in London have rallied, stocks in Europe have rallied. Precious metals have rallied, cryptos rallied. Everywhere you look, things are just moving nicely higher.
Yeah, indeed. Although bonds haven't really joined the party, they've actually sold off a little bit. We've seen French yields edge higher, though when I looked at my chart earlier today, I don't really know what the fuss was about because they actually haven't taken out their previous peaks for this year. Having said that, we've seen obviously some upward pressure on Japanese JGBs. And I think that is having a slight pull effect on UK yields as well.
Yeah, I would make you right on that one. And, we have had a few political developments. Obviously, we had that surprise victory for Takaichi in the LDP leadership election in Japan. France, the Prime Minister resigned unexpectedly on Monday, very unexpectedly indeed. Well, I think Macron's now going to be on his sixth in 2 years, which is quite frankly farcical. And the other development in the bond market that's gone a little bit under the radar this week is we have had two this week and one last week technically uncovered auctions in Germany. So there are some signs that the market is perhaps starting to struggle to digest some of the supply that is coming its way.
And we've got more supply coming, I believe, in the autumn. In
Well, indeed. What a time for Rachel Reeves to be delivering a budget, eh?
Indeed. Anyway, we'll probably talk about that in further podcasts. But before we get started, let's get cracking with the risk warning, shall we, before we get on to the topics. And there's quite a few. So the information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 72% of retail investor accounts lose money when trading spread bets and CFDs with this provider. Always have to remember to do that quarterly recheck.
Yes, indeed.
To make sure that the percentage is correct. Anyway.
How are we in Q4? Can we just address that? First 9 months of 2025 has gone literally like that. And I've clicked my fingers for our audio listeners.
Indeed. I mean, but having said that, what a year it's been. Record highs pretty much across the board. And, I think once again, we've been hearing the narrative, we're in a bubble. And if I had a pound for every time I've heard someone say we're in a bubble, I'd say there's a bubble in people talking about bubbles.
Yeah, well, I put out a tweet to that extent. I think it was yesterday on Wednesday, saying the only place I can see a bubble is in usage of that damn word. I was going to stop myself swearing there. It seems to be getting thrown around all over the place. I think the problem is, people are confusing a market that is rallying and a market where the fundamental bull case is very strong and momentum favors further upside with a market that at some point may become completely detached from its fundamentals and from its intrinsic value. If you look at the US equity market, or really any equity market, yes, AI is powering a big chunk of those gains, but it's by no means powering the entirety of those gains. Nvidia aren't even in the top 50 S&P 500 stocks this year to date. And of course, the other thing to consider is that broadly, earnings growth, very, very solid. Economic growth, very robust. Obviously, we've got this government shutdown at the moment, but Q2 GDP growth in the States was nearly 4%. Q3 has been tracking at nearly 4% as well. And of course, you've got the fact that the Fed are easing into all of this. So you've got an economy that's solid under the hood, earnings growth that's solid under the hood, and the Fed saying, we're going to ease, we're going to make that even more solid, we're going to run it even hotter. The bull case makes a lot of sense. This isn't, to me, a market that's rallying for no reason, or a market that's become detached from its fundamental drivers. I think the bull case and the case for further upside is still a very, very rational and logical one.
Yeah, and ideally, I would agree pretty much with all of that sentiment. US economic growth is fairly robust. It's probably not that robust anywhere else. But then, how do you account for the moves higher in gold and silver, which are haven-driven trades, I would argue. So
yeah,
there is a lot of hedging, I would suggest, going on. People are buying into everything, bonds notwithstanding. So how do you explain it? And before you go into that, obviously, we are going to look at what's driving markets this week, and I think that narrative that you've just outlined is part of that. But we've seen another AI deal, this time between OpenAI and chipmaker AMD.
Yeah.
10% stake in AMD if certain targets are met by processors with a total capacity of 6 gigawatts, coming on top of the $100 billion deal that NVIDIA struck with OpenAI. It feels a little bit like a Ponzi scheme, a very circular type of thing, where the money just is recycled amongst all of these counterparties.
Yeah,
where's the ROI?
Jamie
Dimon has already suggested that there could be, some of it's getting slightly ahead of itself. The Bank of England has weighed in as well. So there are concerns, I think.
Yeah. No, I think you're right, and I think I'm not going to profess to be a sort of hardware or software expert, but the circular nature of those deals does sort of ring a few alarm bells, to say the least. Jamie Dimon's comments were interesting because you talk about hedging through gold and silver. Well, Jamie Dimon hedged himself by saying that the market could sell off at some point between the next 6 months and 2 years. Well, that's about as clear as mud. I could tell you that.
Mind the gap.
Yeah, exactly. I mean, that spread's about as wide as you would have used to quote, I think, back in the city, and you were on the FX desks.
Steady.
But there are reasons for caution. And I think that the return on investment is the big question. Of course, we're moving into the start of Q3 earnings season next week. All the tech names report towards the back end of the month. I think that's the market's question. It's now a sort of show me story where you're going, you've spent goodness only knows how much in terms of capital expenditure on chips and data centers and goodness knows what else over the last year. What's the return? How are you monetizing that? Where's the revenue coming from? And I think that's the sort of stage of the AI cycle that we're now moving to.
But you're not going to see a return on that for quite some time, because before you get a return on that, you need to improve the current infrastructure to deliver that. And power grids here in the UK, in the US, they aren't up to the task of managing that increase in gigawattage, if that's a word.
But it is now.
But that would be required to deliver these sorts of productivity gains, which AI is supposed to be bringing us.
Yeah, and maybe that's where all of this does end up encountering a few hurdles, and we start seeing some stumbling blocks and some dents start to emerge in that bull case. But the question is, I guess, not only the market wants to see that revenue, how long are market participants prepared to wait before they see that being monetized? Because you think about some of the tech growth stocks over the last half a decade, even more than that, participants have been very, very prepared to wait on the promise of future growth, as opposed to seeing that in the here and now. And unless that changes, then you've got to say that the path of least resistance leads higher, I think.
Well, it does now. I mean, at the end of the day, I think that's what you've really got to, you really got to focus on. You've got to focus on the momentum, and at the moment, the
Mm.
momentum is behind pretty much stock markets. As I say, DAX is at record highs as I'm talking to you right now.
Mm. And I think
Um,
this week has been a really good example of that because, I was thinking on the train into the office this morning, it's from a sort of fundamental data newsy perspective, it's probably been one of the most barren weeks you could imagine. Obviously, the
yeah.
US government is shut down. We've had no notable data releases. We had Fed minutes, but, they're pretty stale anyway, as we'll discuss
Mm.
later. It's actually a really good week to gauge where that path of least resistant points because there's frankly nothing to derail markets from just moving in that direction.
Yeah, I mean, and on the topic of UK markets, one of the topics that we're going to talk about, one of the topics we're going to reference is potential thawing in the UK IPO market.
Yeah.
Yeah, last Friday, LED face mask maker Beauty Tech Group, um, valued 271p, £300 million, raised £29 million from 10.7 million shares. And we've also heard from Princes Group PLC. We could also see Shawbrook IPO, which is a challenger bank.
Mm.
The sector has done well year to date, the banking sector. So we'll talk about a little bit about that. We'll talk about this week's moves today's moves actually, in Lloyds and HSBC. What's driving that? Obviously, part of that was down to the FCA announcing the
Yes.
compensation scheme and how much that was largely going to cost the banks. We'll talk about the Fed minutes. We'll recap the results from Imperial Brands, Constellation Brands, and PepsiCo. Not really much to write home about there. Before we look at the week ahead, and obviously I think that's when we can get into the guts of it, because I think that will give us an indication of how well the US economy is doing,
Yeah.
because we got US bank earnings season starting.
Absolutely.
It's pretty much all of them, starting
On
with
the same day,
on the
pray for the
same day.
sell side, please.
Yeah,
if anyone sees me on Tuesday, just don't talk to me. It's going to be horrible.
yeah, 14th of October. Yeah, pretty much the whole banking sector is reporting its Q3 numbers. We've also
Yes.
got wages data out of the UK and unemployment data on the same day, so you're going to be up to your eyeballs, mate.
You
Um,
sound so happy that you're not doing this anymore.
I can't imagine why. Anyway, and then we've got UK monthly GDP. I mean, given what the ONS came out with this week, we can talk a little bit about that. They got the borrowing numbers wrong again.
Oh, yeah.
Well,
Don't even get me started
because
on
they
that one.
miscounted VAT receipts. So anyway, we'll talk about that, and then we'll get another look at recruiters. We
Mm.
had Hayes this week. We've got Robert Walters Q3 numbers next week. Got Travis Perkins, that old social media favourite.
Yes.
So we've got their Q3 numbers. So quite a bit to talk about. But let's start with the thawing of the IPO market. Now, Rachel Reeves was at a JPMorgan tech event earlier this week, wasn't she? Trying to reassure markets she had their best interests at heart.
Yeah.
Where's that Dr. Evil meme when you need it? Right.
Well,
It's okay.
yeah. And I think this is the problem with this, right? Actions speak louder than words. Ultimately,
Mm,
yeah, Rachel Reeves can run around and go to as many tech conferences and as many events and whatever as she wants to, and talk about how we're business friendly, we want IPOs, etc., etc. But you're not actually doing anything in terms of policy to incentivize entrepreneurship, incentivize people to list in London, incentivize businesses to invest in the UK. I know JP Morgan threw a few million here and there this week.
mm,
But I think, I would argue that the message from Rachel Reeves would have gone down very, very badly with businesses because, you're saying one thing, but you're doing something very different. You raided businesses hard in terms of tax increases last year in the budget. There's every chance you might end up doing the same thing again in a little under 8 weeks' time at this year's budget. Frankly, stop the talk and act differently, I think would be the message from most businesses across the UK.
walk the walk,
Yeah, exactly that.
essentially.
Although, as you said, and I'll let you cover this off, we have had some better news in terms of IPOs this week, which is very long overdue and much needed.
Well, indeed, as I say, I mean, Beauty Tech Group, last Friday IPO'd at 271p per share, which valued the business at £300 million. And at the moment, it's still trading above its IPO price. Is it worth that? Is it worth 300 million when revenues in 2024 are 101 million pound? Who's to say? Sales growth was strong though, 27% in the first half of this year. So, maybe this is the first of maybe 2 or 3 more before the end of the year. But given the start that we've had, maybe in the budget, she'll relax the stamp duty rules and other rules on IPOs to make it cheaper for these companies to, basically launch their businesses on the London Stock Exchange. Because certainly I think the London Stock Exchange needs it.
Oh, absolutely. And obviously we touched on the stamp duty stuff, I think, in last week's podcast. My worry with that is, I think it's a good move. Frankly, I think everyone in the market would agree stamp duty on stock purchases is ridiculous. And you mentioned this in your panel, the Good Money Guys Summit the other week. The problem I have is if you're going to have this sort of holiday for 12, 24 months, the first year or two of someone's listing, well, after that period's expired, they're going to encounter all the issues that stocks that have been listed for decades are encountering now in terms of lower liquidity, lower trading volume, et cetera, et cetera. So it feels like a bit of a sticking plaster approach when the better idea would just be to get rid of the damn thing in its entirety.
I would agree. But unfortunately...
it ain't going to happen, is it? We can dream.
We're not sitting in the seat, are we? So moving on, so there's talk about Shawbrook, which is obviously a challenger bank. The banking sector has had a fairly decent year to date. Lloyds Bank shares got a fairly decent lift yesterday after the FCA announced the total cost of the car finance redress scheme will be around £11 billion across the sector, which was at the lower end of expectations. Given a little bit of that back today, because they came out this morning with the announcement that they may have to add an additional provision on top of the £1.2 billion that they've already set aside for the scheme. The reaction seems a little bit OTT, I would say. And down 2.8%. Actually, is it that big a deal? Okay, yeah, it's material, but as long as it's not double what they've already set aside, who cares?
Yeah, I would agree with you on that one, and I think it's hard to reconcile the FCA's announcement, which is well at the bottom end of what analysts had been expecting, and Lloyd's announcement and the reaction to that, which is much more adverse. We need greater provisions. I would imagine, and I don't want to be tempting fate here, but as you sort of allude to, the provisions, they may be material, but they're not going to be anywhere near what they've already set aside. I can't imagine we're talking another billion or so. And I think, the market has probably overreacted to that, particularly when you sort of go, well, actually, there's almost an artificial limit as to how much of a greater provision they can need when the actual total size of the scheme is so much lower than we expected it was going to be. So, I think the move is probably a little bit overcooked.
And also, I was just looking at the share price, and it closed on Tuesday at around 83p, and it's 83.80, so it's still above where it closed on Tuesday, even taking account of today's weakness. And it did pop up to 86.5p yesterday. So it's only 2p, it's just over 2p below that now. So the underlying trend on Lloyds is still higher. So I don't really see this announcement particularly undermining the current positive sentiment around Lloyds, and the fact that this morning they announced that they were taking over the remaining 49.9% of Schroders Personal Wealth that it didn't already own.
Yes.
So the wealth division is likely to continue to contribute to Lloyds' bottom line. And the only downside to that is a slight increase in annual operating costs above the previous guidance of £9.7 billion. So, I think today's reaction is a little bit knee-jerk.
Yeah,
than anything else.
I would very much agree with that. Always nice when we're on the same page.
Indeed. What do you make of HSBC's announcement this morning? Because their share price has taken a little bit of a caning.
Yeah, the market is not particularly happy with that at all, is it? I mean, HSBC has, how do I put it politely, been a bit of a problem child in recent years. I think that's probably fair to say. The idea that they're suspending buybacks, I'm always a skeptic of buybacks. I feel like that's a sign
I
that
don't like them.
no, it feels like the company in question, whether it be a bank, whatever, has just run out of ideas.
Mm.
If the only thing you can do with that capital is to buy back your own stock, I find that a bit odd. I'd rather you were investing that back in the business, which is what HSBC are doing with that acquisition of Hang Seng Bank. So again, I think the market is probably overreacting in terms of the knee-jerk move, whereas actually this could be something that strengthens the operation over the medium term once that integration is fully completed, and assuming that they can get through and obtain all of the usual synergies and efficiencies that they claim they're going to get from this.
Yeah, I mean, the deal is going to cost in the region of $13.6 billion. So essentially, what they've said is they're going to suspend buybacks for the next 3 quarters to basically fund the acquisition of Hang Seng, which it bought in 1965, or took a stake in 1965, and it's basically buying the remaining 37% of the business that it doesn't already own. For me, I think that's cementing its position in its home market of Asia. And for me, I think that could well raise the question as to, because Hang Seng is much more retail based in Asia, that this is part and parcel of the new policy of potentially splitting off the
Yeah,
bank
which
into, yeah, go on.
well, I was going to say, which is a story that comes up once every 6 months or so. Are HS going to BC going to spin off Asia, keep London, etc., etc. But as you say, it does seem to be a move towards that potential as an end game. Obviously Ping An, if I can say it, are very much in favour of that. They've been pushing for that for a number of years. I don't think they're going to stop pushing for that anytime soon. And moves like this are just going to strengthen their case ultimately.
Yeah, and looking at the HSBC share price here today, we've seen some fairly decent gains. As I say, I mean, looking at it now, it's down just over 5% from the recent peaks that we've seen, and it is at record highs. So I mean, for me, this is just a little bit of a minor dip back to its 50-day moving average. It's still above that, and it's still above its 200-day long-term moving average. So
As long as that holds, you would argue that it's a dip there to be bought.
I don't think it materially changes anything.
No, no, I don't think it does either. And I think again, it's just that sort of a little bit like what we were talking about with Lloyds. It's slightly unexpected news that the market has struggled to discount as we move through today's trading session. And give it a week or so, let the dust settle, things will probably look very, very different.
That's the hope, anyway.
But now that won't happen. Now I've jinxed it.
No, you have. You probably jinxed it, mate.
Sorry.
So, Fed minutes, not really much to say and to tell, apart from the fact that I think there was still a residual concern about sticky inflation.
Yeah, I would agree with that. I think, frankly, the minutes were almost a complete non-event. I don't think we really learned anything that we didn't learn from the statement and the press conference about 3 weeks ago. It is interesting that you've got these officials expressing concern over inflation, because obviously I think that's valid. The view or the consensus is tariffs are a kind of one-time shift in the price level. Obviously, there's a risk that does lead to stickier and more embedded price pressures. The other side of that, of course, is that while officials may be saying that in the minutes, they are quite prepared to look through that. And they are quite prepared to ease policy regardless in an attempt to support the labour market ultimately and get in front of any weakness that we may see there. So I'm not sure the minutes really told us much we don't already know. I think the base case is still that the Fed are going to deliver a cut at the end of this month, government shutdown or not. And I'd argue they're probably going to go with a 25 basis point cut in December as well. We talk about the path of least resistance for markets. That feels like the path of least resistance for policy at this point.
And there's still plenty of Fed speakers basically holding court, not only this week. We've heard from a lot of Fed speakers this week, but also next week as well. I did notice in the calendar that next week we actually finally get to hear from Mr. Waller.
Now that will be interesting.
which should be interesting because he's been very conspicuous by his absence. He's due to
Mm.
speak on the 14th of October.
Oh, good. Wonderful.
Along with Chair Powell and Governor Andrew Bailey of the Bank of England. So,
Oh, good. If anyone, Westy, if you're listening, can I have next week off?
and Alan Taylor from the Monetary Policy Committee is also speaking on Tuesday as well.
Oh, brilliant. The one thing that is interesting with the Fed, before we start talking about my tortuous existence next week, is the FT reported this morning, actually Thursday morning, that Scott Bessent has reportedly wrapped up his first round of interviews with those 11 candidates on the, well, I was going to call it a short list, but it's a rather long list, I think.
Do we know who these candidates are?
We do. I'm not going to go through all 11 because I can only remember about 5 of them. But as a result of that, you would expect sometime relatively soon, he's going to filter that down, cut it in half, cut it into a third, and send the top few to President Trump. So I think we are inching closer to finding out who Jay Powell's replacement as chair is going to be.
Are any of the current Fed governors on that list?
Swallows on the list. Mickey Bowman is reportedly on the list, and the Dallas Fed president Laurie Logan is said to be on the list as well. So again, how many of those are sort of serious candidates and how many of those have just been sort of put there to make it look like a proper search? I will leave that up to our listeners to decide.
Wondering perhaps whether that's why Waller's been so quiet recently.
Potentially. Well, all will soon be revealed, I expect.
Anyway, okay, so let's move on to this week's earnings updates, and there weren't that many. Imperial Brands fourth quarter results, bit meh really. Did see a pop higher on the back of those numbers. Just looking at the guidance, they didn't change their guidance. Just went on to say that they expect market share gains in the US, Germany, and Australia, and to broadly offset declines in Spain and the UK. NGP net revenue in line with guidance. And and there's a buyback.
I was waiting for you to get to that. I was going to say, going back to our pet peeve, there was a buyback of basically £1.5 billion for the next financial year. We don't need to go over that ground again.
No, we don't. Okay, so basically that's as you were. It's trending higher. Could well retest the peaks back at £32. So it's one of those dividend payers that generally is an income stock. I'd label it as an income stock.
Yeah, I would agree with that.
What else have we got?
Well, we had Hayes, Constellation Brands, and then PepsiCo today, of course.
Well, Hayes is actually not reporting till tomorrow. So,
well, there we go.
But
sadly, we can't see the future.
No. Well, I like to think that sometimes I can, but I should have seen that one coming. You know, it's the old, raise taxes on businesses. Oh, yeah, I can predict the future on that one. You know, and now we're back 12 months later. If only. Anyway, Constellation Brands, solid Q3 numbers, beat very low expectations, and the fact that the shares are pretty much beaten down is a pretty low hurdle. Same thing that we talked about last week, I think. Higher aluminium tariffs eroding margins, essentially. Yeah,
which they have called macroeconomic headwinds, but that's just a fancy name for exactly what you described. I would fully agree with you. I think the earnings were fine, but expectations were so low, it would have been very tough not to meet them. Yes, they reiterated their guidance, but the guidance was so low anyway because of those headwinds that you just mentioned. So another one where you kind of go through the earnings report and you say, well, not sure we've really learned anything there, to be honest.
Sales continuing to decline in North America, obviously because of the aluminium tariffs, but the international business actually did better than expected. So a similar story with PepsiCo's numbers today. They came out, I think, this morning, didn't they? But
before the open today,
But the market, hasn't really reacted to them. Slightly better than expected. Revenue's up 2.7%, but North American sales down. So they're obviously getting more money, but they're not selling as much.
Yeah, and that was kind of a classic case of give with one hand and take with the other, as you say. Sales up, North America sales down. EPS was basically in line with expectations, and again, just not really much for participants to get their teeth into on the back of the figures, I don't think.
Guidance reiterated, same as it was before, and the CFO's retiring to be replaced by the CFO from Walmart, I believe.
Yes.
So
I suppose the one thing that is worth bearing in mind, of course, we're going to talk about earnings more in a moment, is guidance being reiterated probably isn't the worst sign in the world at this moment in time, because you can take that as a signal that businesses believe the sort of peak of trade and tariff uncertainty is probably behind us, and they're not sort of expecting a flare up on that front. But that could be famous last words on their part.
it could be. I mean, but we're almost a year into the Trump presidency now. Well, I say
Well, we
a
are,
year in.
yeah.
Obviously he didn't really do much between November and January when he was inaugurated, but we're coming up to 1 year from the actual vote, and
Which has flown by.
it has, isn't it? So, I don't think there's been too much in the way of surprises. We already knew what we were going to get. Yeah, okay. He has proved to be somewhat unpredictable. But when you look at the market performance in that 12 months,
yeah,
we're
up 20% or so, aren't we, on the benchmarks? So, yeah.
Okay, so let's look at next week, because Levi Strauss's numbers aren't out until later this evening, so we can't know what your spending patterns have done to their sales.
I was going to say, we all know I've been propping them up, so
we may talk about that a little bit next week. Particularly if they're decent numbers. If they're not, we may sort of just won't worry.
Yeah, well, if they're not, let's hope they have a sale. Shall we move on to next week?
Yeah, wages and unemployment, Michael.
Well, let me get my bucket of salt ready to interpret that data with, first of all.
Okay, so the unemployment numbers, we already know that the ONS aren't particularly good at that. Are they going to be any better at the wages numbers?
You know what? I think we've raised this point before, but for those who are unaware, we've had another shambles at the ONS this week. As you alluded to earlier, this week they've come out and said that they've got their public borrowing stats wrong since January, in the January to August period, actually overstating borrowing by £3 billion. So it has sort of worked in Rachel Reeves' favour, but there you are. The problem is we're now at the point where we've got issues with jobs, labour market data, inflation data, trade data, retail sales data, GDP growth data, and now add public borrowing stats to that mix. You're sort of at the point now where you kind of go, well, actually, I'm not entirely sure we can really trust anything that's coming from the ONS, because you've got this long laundry list of stuff that you've told us you've got issues with and we know is wrong. You've then got all the other data releases where you've kind of got to go, well, we need to assume that there's something wrong with them, because either there's an error that you haven't found yet, which is very, very probable at this moment in time, or that data is reliant on other data that you've admitted there are errors in. You think about, for example, import and export and trade data. Well, that automatically feeds into the GDP numbers. So it's going to skew the other one. So I think we're now at the point where you almost have to look at everything the ONS release and sadly question the data. You can't just look at it and go, that's how the UK economy is doing. You have to have a little bit more of a sort of skeptical mindset. But I think that setting that aside, the labour market data we get this week will be interesting, because the problem for the BOE is the labour market continues to exhibit a greater and greater margin of slack. Unemployment has been ticking higher, payrolls have been ticking lower, but at the same time, earnings growth is stuck at, as near as makes no difference, 5%, which in no one's world is compatible with a return to that 2% inflation target.
And you've got businesses still concerned about higher costs and having to raise prices as we head into the Christmas period. So that means that inflation is unlikely to come down as quickly as the Bank of England would like.
Yeah, absolutely. And of course, we're still...
Yeah, go on.
Well, I was going to say, we're still a little bit away from the next inflation numbers. They come on the 22nd of October, so not next week, the week after. The BOE expects September to be the peak. If it's not, that's when we've got a real issue on our hands. That's when you're starting to go, well, if the peak isn't 4%, how high is the peak going to be, and when is that peak going to come in? That I think is going to be the worry for policymakers, and that's also why money markets price just 6 basis points of easing by the end of the year.
Yeah, but I don't think it's less about what the peak is; it's about how quickly it comes down. Because if it peaks at 4% and stays at 4% till the end of the year,
that's problematic.
They're just exactly. They're in just as big a bind as if it goes to 4%, goes up to 4.2, and then comes back down to about 3.5 by the end of the year. They still can't cut rates.
No, and of course this comes at the same time, and we may as well move on to it, as economic growth continues to basically stagnate. The only thing that's been propping up economic growth, certainly in the second quarter, was government spending. And as we discussed at the time, well, the government can't afford the spending it's making. So, the government is propping up GDP growth by this runaway spending, but we can't finance that, because that's why we're looking at 30 odd billion quid's worth of tax hikes in the autumn budget.
Yeah, so we've got August GDP on the 16th, and those of you who've been regular listeners and viewers to the podcast will know that I'm fairly sceptical about these numbers. But having said that, they do give an idea. They give an indication of what different parts of the economy are doing. And we saw a decent performance in June, but July slowed to 0, with manufacturing falling sharply. What's August going to be like?
You can't imagine it's going to be much better, can you?
No, you can't. I can't imagine. I mean, we already know from recent PMI reports that hiring has been slowing sharply. Price pressures are starting to reassert themselves, and consumers are holding back. So
and you look at the data and you go, the trend is clearly a downwards one. The economy is clearly slowing. It's clearly been losing momentum. What's the catalyst to turn that trend around? Well, I don't think there is one. Certainly not if you look back at the summer months. And then to go back to that, we're now in this period of 2 or 3 months of uncertainty around what is going to happen in the budget in November. That's also going to act as basically a handbrake on any sort of economic activity, whether that be business investment, consumer spending, et cetera, et cetera. So, I think, and I said this at the time, the GDP growth of 0.3% in Q2 is probably as good as it's going to get this year.
Well, there was a report this morning out from the Institute of Chartered Accountants in England and Wales, and they were saying that confidence was in free fall.
Are you surprised?
Ahead of the budget on November the 26th, with bosses already cutting spending in anticipation. Its latest barometer of business confidence showed 6 in 10 businesses cited the tax burden as a growing challenge. This is the highest proportion on record and represents a tenfold increase compared with 5 years ago. The ICAEW blamed the Chancellor's £25 billion increase in employer national insurance contributions, as well as potential tax hikes in the upcoming budget.
I think that says it all, doesn't it?
It does, really. And to be quite honest, it's a little bit depressing. But
it is.
Sadly, that's where we are. Anyway, let's move on. We've got Whitbread's first half numbers also due out on the 16th of October, same day as UK August GDP. Now, they issued a bit of a profits warning back at the end of the first quarter, because total UK sales revenue fell 5.4% to £648.2 million. That's UK sales revenue. So that's a big fall.
Yeah.
But the shares are actually higher today than they were at the end of the first quarter numbers. So that just goes to show that just because you've got a bad set of earnings numbers doesn't necessarily mean that the share price decline that you saw on the day in question is going to be sustained. We've actually edged higher. We're at the highest levels this year and back at the highest levels since this time last year before the last budget. So it's interesting. It's interesting the way that's played out, because the end of 2024, we slid quite sharply lower. We hit the lows back in April. Since those April lows, post Liberation Day, when pretty much everything fell.
Everything fell off a cliff, yeah.
The Whitbread share price basically recovered back to the levels it was just before the budget last year. So
yeah, which is a remarkable move. I think the key for market participants as we move into this earnings report is going to be in terms of the forward-looking statements and the transformation plans that they've got going on. As you've written here, they've said in their previous report they remain confident in delivering 300 million in incremental profit by 2030 and unlocking £2 billion for shareholders in dividends and those damn buybacks that we keep having to talk about. I think that is going to be the market's focus. Are they reiterating that prior guidance, or do they even upgrade that prior guidance? I think that's where participants are going to be looking quite closely.
Yeah, indeed. I mean, they've been expanding the German business, and revenue there has actually been growing quite solidly, but it still makes up a very, very small proportion of their overall annual revenue. I mean, I'm looking at the sales numbers in Germany, or the revenue numbers. It's 62.7 million out of 700 million. So it's still a very, very small proportion of their business. So it is actually improving. Anyway, so that's Whitbread, Premier and owner Whitbread.
Yes.
So if they can't have a good second quarter, summer months,
they've got a problem.
Whatever, they've got a problem. So that'll be interesting to see whether or not they offer us a guidance uplift.
Yeah.
We were talking about employment. We were talking about trends in labour markets. Obviously Hayes being a case in point last week. We've got Robert Walters next week.
Yes.
And I think with so little visibility, I think these reports are especially important, not only in terms of the UK, but I think also around the various regions of the globe. But I think in this case, we will be looking at the UK component of this report. So
no, very much so.
When I looked at the share price for Robert Walters, it mirrors virtually identically the Hayes share price,
which is not entirely surprising because by and large recruitment agencies, recruiters, staffing firms, whatever you want to call them these days, they're all dealing with a very similar environment and operating along the same sort of cyclical nature. So you would very much expect that. I think what's going to be interesting, not only in terms of the UK, but just in terms of operations largely, is the labour market globally, and mainly you see this in the US, is kind of in the state of no hire, no fire, where companies are not actively hiring a large number of workers, but they're also not really laying that many workers off because they want to sort of hoard those skills in case things do pick up in the future. So I guess that's the sort of colour that we'll be looking for in those figures.
I was looking at the regional breakdown of the fee income for Robert Walters, and it's actually quite a stark picture. Asia Pacific, which accounts for 43% of its sales, of its fees, saw a 14% decline in fee income. Europe, a 23% decline in fees. And the UK, a 6% decline in net fee income. Since that first half update in July, the shares have hit their lowest level since 2009.
Yeah, which, safe to say, was not a particularly great time for anyone.
No, exactly.
Maybe slight understatement there, but
no, indeed. And I think the one thing I take away from that is things aren't as bad now as they were then.
Yeah.
So perhaps there's an argument to say that these share price declines are a little bit overdone. Now, having said that, obviously the fact that Robert Walters said that they weren't going to restart the dividend until well into next year obviously hasn't helped its case.
No, not at all. So yes, one to watch there.
Yeah. Travis Perkins, our old favourite.
We might go viral again.
Yeah, indeed. They've actually done okay. Haven't really done that much over the past quarter. Traded in a range between 650p and 560p, but towards 6-month highs. So this is in Q3 numbers. So
yes.
This is a tricky one because I think the merchanting division has been struggling for quite some time now. I'm not sure that's going to improve. Toolstation, on the other hand, has continued to perform well. Operating profits rising to £21 million, which is a 50% increase in its first half. So full-year guidance for adjusted operating profits, I think, will be the key thing here for me.
Yeah, agreed. I've been doing some I've been running the numbers on Travis Perkins,
Oh,
and
brilliant.
since the start of 2020, the stock has only rallied after its earnings release twice on the day of the earnings report. Now, of course, past performance is not a reliable indicator of future results, etc., etc., etc. But it is clear that in recent times, at least, the market has reacted rather adversely to the figures that the firm has been putting out.
Mm. And it is trading near its highs. So
Potentially buy the rumor, sell the facts.
possibly. So there is evidence that maybe the shares are turning a corner. I'm looking at the lows every time it's dipped. The dip has been shallower. So it'd be interesting to see whether or not it can take out that 650 level that's capped it since pretty much February. Anyway, so
But the big ones.
The big ones. We're moving on to the big ones now.
And my horror show of a day.
Yeah. JPMorgan, Wells Fargo, Citigroup. I'm going to focus on them. We've got Goldman Sachs, we've got Morgan Stanley as well, but
yeah,
I think these three banks will tell us more than enough of what we need to know about the US economy, the housing market, loan demand, and whether or not consumers are basically just holding back a little. I think they're a decent bellwether of how confident US consumers feel. And recent earnings numbers, to my mind, have suggested that the US consumer still remains fairly resilient.
Yeah, I would strongly agree with that. And I think one of the things that will be very interesting in the bank earnings, there's a few takeaways, of course. The first is that sort of barometer of consumer health, as you alluded to. The second will be one of the things that we saw certainly in the second quarter was the degree to which trading revenues really underpinned a lot of the performance from those banks. Obviously, markets were very, very volatile in Q2, not quite as volatile in Q3. So be looking to see how that trading revenue line performs. And then going back to one of the topics we were discussing right at the top of the show is M&A activity and corporate actions and IPOs. That has picked up considerably stateside in the third quarter. We have seen much more deal making activity, much more M&A going on. So be looking to see how the banks have been benefiting from that, because one of the things when Trump came to office, we all expected this surge in deal making, this surge in M&A, and it didn't quite happen because of the uncertainty around Liberation Day and all the rest of it. Now we might finally be getting that delayed wave of corporate activity and deal making that we'd all been expecting for so long.
Yeah, I'm looking at the share price of these three, JP Morgan, Wells Fargo, and Citigroup. And I think Wells Fargo is probably the interesting one because it doesn't really have what I would call an investment banking division. So it's much more exposed to the winds of consumer sentiment, consumer spending, and that sort of thing. And in Q2,
sorry, go on.
So in Q2, there was a disappointing reaction to the results for Wells Fargo. But the share price performance has been pretty much identical to JP Morgan and Citigroup, which suggests to me that even though JP Morgan's results were good, Citigroup's were good, and Wells Fargo's weren't, the numbers don't really matter that much.
Well, yeah, there is certainly a case to be made for that, to be completely honest with you. The other thing that I think is interesting, because I was doing a bank earnings preview for Pepperstone this week, little self-promotion, was Wells Fargo, the Fed lifted their asset cap in July. I think it was end of June, start of July, which, they'd had this asset cap in place for 7 or 8 years. Wells Fargo had been saying, it's really inhibiting our growth, et cetera, et cetera, et cetera. The Fed finally got rid of that. Basically saying to Wells Fargo, you can do what any other bank in the United States is doing. And the market just hasn't reacted to it at all. Now, I don't know whether that's because, it was all priced in, because Wells Fargo haven't delivered any upside on that. But I think that's something that's going to be quite well worth focusing on in the Wells results is, now that they are not as restricted as they have been for donkey's years, are they really able to capitalize on that?
And one thing I have noticed over the past couple of weeks is all of the US bank share prices have drifted off their recent peaks, drifted back towards, and in some cases below their 50-day moving average, which is interesting because they haven't done that for a while.
Yeah.
They haven't been below their 50-day moving average pretty much since March, April. So, and they're looking a little bit oversold. is that symptomatic of a little bit of profit taking? They're still within their broader uptrend above the 200-day, but momentum there does appear to be wavering. So it'll be interesting to see how they view their final quarter, what their guidance is as we head into the Christmas period and the Thanksgiving period for the US economy, because that's a big quarter for US consumers and US retailers as well.
Yeah, no, very much agree with you on that one.
Okay, so that pretty much wraps things up for this week, ladies and gentlemen. So our thoughts and prayers will be with Michael on the 14th of October.
And if I survive that, I'll be back for another podcast next week.
Indeed. So until then, have a great weekend, have a great week, and we'll see you all next Thursday.
Bye for now.